Welcome to the Home Building Hub, your essential podcast guide to building your new home. Hosted by industry experts Colin Bischoff and Darren Brennan, this conversational podcast will help better educate you about all things new home building so you can avoid costly mistakes and enjoy your building experience to the fullest, no matter which home builder you choose.
Hey there, folks. Welcome to the Home Building Hub. You're with Colin and co-host Darren Brennan, as always. And Dazza, this week we're welcoming back Scott, the broker Baker from Toast Finance. Episode number 2 he's doing for us. Today we're going to cover the top 5 strategies on how to pay off your loan faster. So for those who, in case you missed it, Scott joined us last week covering off 5 things you need to know if you are self-employed and you need a loan. So jump back and listen to that. And just to cover a bit of an intro, Scott is from Toast Finance, CEO and the founder. And Scott is actually my personal broker, and he's sort of one of those wizards who find a solution when the lazy brokers or the box ticking brokers cannot be bothered. So he has a team of brokers there that work with him, ready to roll. So as we always say, Darren, you need to find people who actually know what they're doing, brokers, accountants, and that will give you the best chance of getting a loan for your investment, for your dream home, for anything in between it. And I vouch for him well and truly, have done for many years. So thanks again, Scott, for joining us. Appreciate you coming on board for episode number 2. Let's jump into the topic. Yeah.
Welcome back, Scott. Welcome back, mate. Great to have you on board. And the last episode was fantastic. So really looking forward to this one. And I think this is a really broad topic, about how to pay your loan off quicker. Hopefully save a few bucks along the way too. But maybe kick off, what is one of the easiest ways to pay more than the minimum off your loan, I guess without really noticing that you're doing it. And obviously that's going to save you hopefully time and money.
Yeah, look, I think one of the simplest ways is repayment frequency. Now, most people, when you set up a loan, it'll be monthly repayments is the default you will go to. But one of the simplest ways you can do, which can wipe years and tens of thousands of dollars off the loan, is to simply be changing your monthly repayment to fortnightly. Now, one little trick to be aware of here is when you change your repayments to fortnightly, you just want to be dividing the monthly repayment in half. Now, the reason that's more effective is because there's actually more than 4 weeks in a month. 4 weeks is 28 days. Every month's got 30, 31, etc. So by actually just dividing the monthly repayment in half, you're actually paying a little bit more than the minimum. And it's a very powerful tool to wipe years and save tens and tens of thousands of dollars off the loan.
Very simple, mate. Very simple. Yeah. And obviously, like you say, divide, if you're paying monthly, you're getting 12 payments. But if you're paying fortnightly, you're going to make 26 payments. So you make 2 additional sort of half payments. So you get 1 extra whole payment in over a year that, obviously adds up over 30 years. You've got 30 additional payments, which will then at the other end reduce that number off the other end of your loan, I assume.
Massively. And I think something that's also really important here and is powerful is getting these kind of habits or structures set up from the start. Because right at the start of the loan, you're actually paying more interest than you are principal. So getting these behaviors in place early really helps accelerate the rate at which you're paying the loan off because of how much interest you are paying at the start of the loan term.
For sure.
Sorry, on that one, so splitting it in half to fortnightly, what about for people who have a little bit of extra money in the kitty? Is there any benefit to contributing additional payments over and above?
Definitely. And this is where, when the banks are calculating how much interest they're going to charge you, they're calculating every day what your loan balance is. Now, they're going to charge you interest once a month, but they're doing the calculations every day. So any additional repayments you can make is so powerful to really minimize interest on the loan. And that can be used a couple of different ways. There's a couple of different, I guess, tools and features linked to your loan that you can do. Now, some people might want to transfer those additional payments into the loan, and you can do it manually, set up automatic direct debits. But another tool that a lot of people are using now are offset accounts. Now, an offset account is just a normal bank account. You can have your pay go into it, pay your bills out of it, have your debit card linked to it, all that stuff. But basically in the back end, an offset account is linked to the loan. And anything you've got sitting in your offset account is having the same effect as it's sitting on the loan and reducing the interest you're going to pay. So I'll give you a bit of an example. Let's say you got a home loan, $500,000, and you've got $50,000 in your offset account. Now, every day the bank's calculating how much interest are we going to charge you. So they're going to calculate it off $500,000 as your loan, minus what's in your offset account, which is 50. So they're only going to charge you interest on $450,000. And this is a very powerful tool as well to significantly reduce the interest you're going to pay on your loan. And also with offset accounts too, for a lot of people, it becomes personal about how do you manage your life and internet banking and all that type of thing. Some people are very simple. They're like, I just have one account for everything. My pay goes into it. I pay my bills out of it. I like to keep it simple. Whereas other people maybe have read the Barefoot Investor series of books and they have lots of accounts for different purposes. There's a pay account, a bills account, a holiday account, a kids account, all of that type of thing. There's actually lenders now that you can have all of those accounts as offset accounts and all of them being productive and reducing the interest you're going to pay. And it's a very powerful tool. And this is a really key point for people to keep in mind is when you've got mortgage debt, you need to be thinking of your offset accounts as savings accounts. Because if you've got money sitting actually in a high interest savings account somewhere else, whilst you're earning interest, you're going to pay tax on that interest at tax time. So any interest you earn, it's not even all of yours anyway. So when you've got mortgage debt, you've got to think of your offset accounts like your savings accounts because you'll actually be better off in reducing the interest you'll pay on your loan versus the taxed amount of income you're going to get from a high interest savings account.
You wouldn't find that many high interest saving accounts with a higher interest rate than your mortgage either, would you, at the moment?
No, they are a little bit lower. Because something we've seen in the last couple of years when interest rates were going right up is savings account interest rates were going up as well. And I think a lot of people at default go, well, if I've got savings, savings needs to go into a savings account. It's like, actually, no. When you've got mortgage debt, one of your offset accounts you need to psychologically think of as your savings account because you'll be far better off at the end of the day and the interest you'll save paying your loan down even faster. And
you've got obviously access to those funds. You haven't tied it down for a period of time. Often it's there to be used if you need it.
Yeah, absolutely. And this is the beauty of offset accounts. I get a lot of questions about, can I touch the money? Like how it's like, it's a normal bank account. It's your money. It's sitting in these accounts. But any amount of time that you've got money sitting in these accounts, you can't see it, but in the back end, it's reducing the interest you're going to pay on your loan. And this is why the whole multiple offset account strategy has been really popular because, a lot of people have different accounts for different purposes and psychologically know that when they get paid, this much goes into my bills account, this much goes to save for my next holiday. And as you're moving this money into these different accounts, you can still operate the same and know that you've got all your money organised, but every single dollar you've got to your name is being productive and yet reducing interest on your current loan.
Yeah, good.
Yeah, it's great. What about the difference between, offset you've explained, what about redraw? What's the difference between a redraw and an offset account?
Yeah, so a redraw is linked to the actual loan. So if you've got a home loan and you've got $5,000, you can transfer it into the loan And that'll reduce the loan balance down, and you'll also pay less interest. So having money in redraw or offset is going to have the same financial benefit. But this is where it becomes very personal for people. Some people, psychologically want to know, I'm transferring the money into the loan, I can see the loan balance going down. But redraw means if you've transferred $5,000 into the loan, well, you can redraw it out again. So if you've paid extra, you've paid more than the minimum repayment, put that extra into the loan to reduce some interest. But hey, maybe your car's broken down, you need to get it repaired. You can redraw that money out and then go and use it as you wish. And redraw is a feature every home loan has. It's not a special thing. It's a simple feature every loan will have, and it doesn't cost anything too. You can do unlimited redraw, put money in, pull it out, in and out, in and out. It's just more of a manual way to get the benefit of that interest savings.
Just on the offset stuff, not committing to a figure or anything, but just so people actually truly understand how many years it can shave off your loan if you're contributing extra funds or using an offset account, which reduces the amount you got to pay, or cutting your monthly down to fortnightly. Like, is this something that shaves off a couple of years, or in actual fact it can be 7 to 10 to more years of your having to repay that loan?
Yeah, it all comes down to the figures, but people would be surprised. And you can either chat to your broker, or there's calculators online. If you Google offset savings calculator, there'll be oodles of calculators online that you could just go and have a play with. But I think you'd be surprised at what these good habits of paying extra on the minimum or using offsets, how powerful it is at wiping years. And it's not even just the time, it's the interest. Like as a rough example, if you've got a home loan of $500,000, based on where interest rates are today, you're actually going to repay to the bank over $1 million. So the bank over 30 years is getting over $500,000 in interest. Like, that is mind-blowing. And this is why banks make billions of dollars in profits, because over the long term, how interest is calculated, this is why they make so much money. So disciplines people can get in place early around using offset accounts, repayment frequencies, paying more than the minimum, is so powerful at reducing interest and keeping it in your back pocket and not the bank's.
For sure. I guess you see a lot of people looking at refinancing their loans. How can people make sure they don't end up paying more interest when that's the case?
Yeah, one of the big things we see is with people when they're looking to refinance, firstly, it's understanding why we're refinancing. And a lot of the time, refinancing is not about the rate. It's about solution, or it's about features, or it's about what they're looking to achieve. But a big thing with refinancing that is making sure your broker's just not automatically pushing it back to 30 years. Because this is where you will pay more interest and it'll feel like it takes forever to pay your loan off, is if you've had your loan for 3 years and you're refinancing for whatever reason. If it gets pushed back to 30 years, you're going to be paying even more interest. And the big reason for this is, and I'll talk to kind of how a mortgage works here actually, is a mortgage is an amortized loan. Now, what does that mean? An amortized loan is where your repayment every month from the start of the loan to the end of the loan has a different level of principal and interest. So over 30 years, it's not just 50-50 principal and interest over the whole time. In month 1 of a 30-year loan term, most of your repayment is interest and a little bit principal. Fast forward to year 30, it's virtually all principal and no interest. And again, this is how the banks make billions of dollars in profits. The average home loan in Australia gets refinanced, I think it's about every 4.5 years at the moment. So that first 4.5 years, are you just paying truckloads of interest and not a lot of principal off? And this is why if you've had your loan for 3 years and you refinance and it keeps getting pushed back to 30 years, you're just paying truckloads of interest. And again, it's like understanding what are you doing or what are you using the strategies around offsets, redraw, repayment frequency to make sure you're going to minimize that interest you'll pay, especially at the start of the loan term.
Yeah, good. And obviously, again, I think it's great advice in terms of aligning it, not going back to 30 years. If you've paid off 5 years, go back and get a 25-year loan. You might be doing because you want a little bit more money, and obviously in a falling interest rate market, you can certainly look at not necessarily being concerned that, sometimes people do it to reduce their interest rate payment too, right? Or to reduce their overall payments while they push that time frame out. With a falling market, hopefully that's looking after itself a little bit anyway. So, if you need that little bit of pressure off because the cost of living pressure's got to you, the interest rates dropping obviously is starting to do that for people as well, which is good.
Yeah, totally. And that's it. Yeah, some people, would go back to 30 years. Maybe they need that for borrowing capacity reasons, to bring the repayment down. But it's before you go and do that, it's understanding what are the implications around interest. And also getting your broker to show you that if you had a 27-year term and you're going to go back to 30 years, your broker will be able to show you what extra repayments do you need to make or offset account balance you need to have to still pay it off in 27 years. And I always say to people, if things are still okay with repayments and comfortable at the start, try and actually set up an automatic direct debit for that additional repayment. So you'll still pay the thing off in 27 years anyway.
For sure. I notice also a lot of banks at the moment, while interest rates are dropping, maintain that the higher repayment amount. So, there might have been a couple of interest rate drops, but a lot of people's loans won't have, the repayment amount won't have dropped, which is obviously also just helping in the long term in paying off your loan quicker, which is obviously what this episode's all about.
Yeah, that's it. And that is a tool that's, we've had 2 years of interest rates going up, so people are only used to that. But now rates are going down. It's like, what go, it's a new environment. And that is a big one that, most lenders, when interest rates get cut, the repayment won't automatically come down with it. And look, that just helps you pay the loan off faster. So the bank's going to charge you less interest every month. But if your repayment's the same, think of it like forced savings. You're actually getting ahead of the loan and building up your own level of equity that you can control.
What's fascinating in this is we have a character we refer to Uncle Gary here, Scott, and Uncle Gary is the barbecue expert, the uncle or the auntie advice that they haven't built a house for 20 years, but they're telling you that what you should do now and all that sort of stuff. And in this topic, I'm hearing Uncle Gary telling you to stick with insert bank name here, because I've been with them for my whole life. And people need to understand, if you're new to this, your mission is to get the house. Whether it's established or build a new home, it doesn't matter. Your goal, get yourself a property. And number one, work with a broker who can look at all the lender options available to suit your circumstances, is one that I find people go, no, I'll just go to the bank because that's where my pay goes. And that's who I've been dealing with for 5 years or 50 years. Worst thing you could ever do. I'll say that because I don't know if you're allowed to say that, Scott, but that's just, you've got to go to a broker, number one. And number two, you are not in any way, shape or form. I think people are a little unsure about this refinancing term. You are not connected emotionally in any way, shape or form to your lender. They are making a bucket load of money from you, and you have the right to have your broker say, hey, we got you into the property on this lender, and then now you've moved in, we've settled it all, etc. Let's have a look at the other options. Like, you need to be open and understand that that's just the game. So strategically, I guess, Scott, for those who are new to it, what could you share on that in terms of their strategy? If someone's fresh right now, just thinking about, do I have the money, whatever, and they're getting Uncle Gary in their ear saying, you've got to go to the Big Four, and what can you say about that? Yeah.
Yeah, look, it's right now, 75% of all residential lending is done through a broker. And the big thing I find with that is, it's brokers are there to help people achieve their goals and to work in the client's best interest to make that happen. Where banks are actually not obliged to work in your best interests. And it's about solution and competition, and I think brokers help with competition because there's so many options. And really, at the end of the day, the biggest thing that determines what lender fits for a client is their policies. At the end of the day, if we're looking at lots of options, the rates are all, roughly going to be roughly the same, but it's actually who's going to get the job done. Are you building your first home? Are you building your fourth investment property? Whatever your solution, goal you're trying to achieve, lender selection is about policy and who's going to get the thing approved and get it done with the least path of least resistance. Once we know those options, sure, we go and look at the lowest rate after that. But it's really solution driven. These days, no one buys their first home and lives in that home for 30 years. I think when my parents back in the early 80s bought their first home, that was more common. I mean, I lived in the same home for my entire life of growing up. It was much more common back then. But these days now, property is just your first home. It's a solution to help you onto the next goal, and you might buy it because you're single, and then, you get a partner, or then you might want to buy a house together, or then you have kids, or then you want to put a pool, life happens, and this is why the lender you're with is going to change over time based on what you're looking to achieve at that point in time. And with Uncle Gary telling you to go down to your local bank branch, I mean, based on your personal scenario, that bank could give you significantly less borrowing capacity versus someone else out there. And you don't know unless you see the options. And that could stop you from delivering the actual goal you're looking to achieve.
I think also, Cole, when it was people going down to their bank branch in times gone by, I always remember my mum and dad talking about it. They knew the bank manager. I wouldn't know a bank manager. I wouldn't know him if I crossed him in the street.
There actually was a relationship in place.
Correct.
And they did have the authority to, look, I actually know this person. They had a bit more leeway. Back in the day, bank managers had the power to make some decisions, whereas it's a little different now. So times have changed, and for those fresh in the game, don't listen to Uncle Gary. You need to just talk to a broker who has the experience in, if it's construction, then they must have construction experience. That's very important. Because they've got all the options. The person at CBA or at NAB or whatever, they're not going to recommend each other. They're obviously there to recommend the bank they're working at, right? No offense, Dazza, if I'm sitting in front of a client, I'm not going to recommend your building company over the one that I'm trying to put in front of them. It's just not the way we do it. I love you and all, but I'm just not going to go that far. But it's just common sense, I suppose. So
what do we say? Between 9 and 5, it's war. Between 5 and 9, it's friends. Is that?
Sure.
We've
had a few, actually, truth be told, Scott. We've had a few clients cross paths with Darren and I, and we sort of take notes on it and work out who can get the best one. He wins a couple, I win a couple, and that's it. Off we go. So
that's how we roll. That's how we roll. Hey, what's the biggest mistake you see people make that's slowing down the rate at which they can pay off their loan, Scott?
Yeah, probably a couple of things. It's probably around not understanding features and how to use their loan, and whether it be using redraw or offset accounts that we talked to earlier, and also inaction, whether it be setting up additional repayments or setting up multiple offset accounts. I think it's really just understanding there are tools there that you can use, and it doesn't take a lot of work. Like I was saying before around offset accounts, if people use multiple accounts for different purposes, and I see this so much, people like, well, I've got 2 accounts with NAB, 3 with ING, 1 over there with UBank, and then I've got my ANZ home loan here. It's like, actually, if we just bring all of that together, you can still behave exactly the same and have your money, for bills, for holidays, for savings. But if they're all as offset accounts, they're all actually working for you and going to pay your loan off so much faster. So I think it's just understanding your loan products and, not being afraid to ask your broker and go, well, hang on, this is how I'm operating now. Is this the right way to do things? And that's a big thing as brokers we do is just help people how to structure their banking and life a bit as well. Understanding how they operate and then helping explain how to use those tools to get the effect.
It's very good. I think some great tips in there and some simple stuff right at the top for anyone, whether you're on your first loan or your 10th one, because there are just things in there that most of us are not doing, and they're so simple and a quick little adjustment, and that can shave off years of repayments, which who doesn't want that, right? So excellent stuff. And what we'll do is we'll put Scott's details on the bottom of the description. So if you want to reach out to him, please do so, and he'll be able to put one of his team in touch with you and look after you from there. So, Scott, once again, episode number 2. Thanks again for, putting up with us for a second time. And, just amazing tips, insights. Definitely an area that the feedback, as I said last week, some feedback from people to us is they want to hear a bit more of this stuff. New home construction stuff is obviously helpful, sometimes pretty complex, but this is so important, right? Because this is what gets you the loan, this is what gets you the build, and this is how you manage it thereafter. So thank you very much for coming along again.
Thanks for having us.
Good on you, Scott. Great to meet you.
Excellent. Guys, any feedback, any questions, homebuildinghub.com.au. Please jump on, leave a 5-star review for us on whatever platform you're on. We'd love that. And reach out to Scott and his team at Toast Finance. You will not regret it. Thanks very much for listening. Talk to you next time. See ya. Thanks for listening to the Home Building Hub. As part of the podcast, we have to be a little careful to cover ourselves on a legal standpoint. So we do have a disclaimer. Whilst we're all about providing value to you, this podcast should not be considered legal or financial advice. It does contain general information only, and you should seek out independent professional advice on your own personal situation before you make any legal or financial decisions.
1,